Thank you for having us today again. Let's begin by discussing the value strategy. I'd like to delve into the value strategy because you're very good at value strategy. The environment for value investing has been challenging for over a decade. Growth stocks, particularly in tech stocks, continue to dominate and the performance gap continues to widen. By the way, some of our viewers may not fully grasp the concepts of value versus growth. So could you please explain what value strategy entails in contrast to growth strategy incorporating your firm's approach?
Sure, great. Well, thank you very much. I think you're right that the last decade has been very difficult for value investors, particularly here in the US. The market's been very dominated by large cap growth stocks, particularly technology companies, which has been a challenge for a value investor to outperform the index. At heart, what value investing is buying companies that generally could be out of favor. They're quality businesses that are being mispriced by the market, low expectation companies, that there is the belief that over time that value can be unlocked. When we look at the growth side of the spectrum, these companies have very high expectations that are more than priced into the market. They tend to be momentum companies that have done well, that continue to do well. You know, we have growth and value indices. Value indices are characterized by low price to book, low PE companies. Growth indices by high price to book, high PE companies. When we look specifically to Harris Oakmark, and how we look at value philosophically, clearly we're buying companies that trade at a discount to their intrinsic worth, and we carry out extensive research to really understand that. We're looking for companies that grow that shareholder value over time. And then the third thing is that we're looking for companies where management is aligned with us. And I think that's very important because just buying a cheap company doesn't necessarily mean you can outperform, but buying an undervalued security with catalysts to outperform, we think can do very well over the long term.
Thank you. The next question is that historically, periods of strong value outperformance and strong growth outperformance have alternated, with each strategy excelling in different market conditions. In what kind of environment does the value strategy typically demonstrate its strength?
Yeah, it's true that value and growth have alternated from a performance perspective over time, particularly when you look at the indices. I would say that over the very long term, value has done very well, but there have been periods of very, very significant underperformance of value in that time period. I think broadly, what is the best environment for value to do well? It's where the markets are focused and investors are focused on fundamentals of companies. They're not focused on themes, they're not focused on stories, but they're focused on fundamentals of companies. Ultimately, companies are worth the present value of future cash flows. That's what we focus on. DCF's really trying to understand the true worth of a company. When markets deviate from that, we see that growth as a style may well do a lot better. Another factor that is important for value strategies to do well is that the market is not a momentum market. Recently, here in the US in particular, momentum has been an extremely strong factor driving market returns. And in that sort of scenario, you can see that value can underperform for a sustained period of time.
Okay, thank you. As you mentioned about the momentum is a very strong factor now. So I'd like to ask the relevance of fair value and value growth cycles. As I just mentioned, the disparity between growth and value stocks continues to widen. While growth stocks do experience downturns, many seem to continue rising in the long run, irrespective of their valuations. Does the idea that stock prices eventually settle at their fair value still hold true today? Because I'm always struggling to explain what's happening now. So, and do you believe that distinction between value markets and growth markets is still relevant?
So I think that, most certainly companies should trade at fair value over the long term. There is little doubt about that. I do think that right now, the market cycle, as we've mentioned, is very much growth focused. The companies that are driving the market have very high expectations. The US equity market today is very, very concentrated in a handful of companies, But ultimately, fair value must win out. When we look at the last major growth cycle, obviously in the late 1990s, the tech bubble, obviously growth did extraordinarily well over that time period. And that was then followed by a period of sustained value outperformance. And that didn't necessarily mean that value as a style did better, but it meant quality companies that were fairly priced were then able to achieve their full value, whilst these very, very expensive companies underperformed. So I'm not quite sure whether there's a cycle per se, but it's just that these periods of expensive companies continuing to do better likely cannot last forever. And so if we actually put some numbers on that, today the S&P 500 trades at 23 times earnings, which is really quite expensive for the broad market index. If we look 10 years ago, it was only at 17 times earnings. So we see that there's, a lot of expectation already built into the market today. The value index trades at only 17 times earnings. Our own portfolio here in the US only trades at 12 times earnings. So low expectation companies that we believe will and can do well over time. And it won't take much for and I wouldn't call it a bubble per se, because, some of these companies that are driving market higher are extremely good companies, but they're just at very, very elevated prices. It won't take much for the market to realize this and value to do well once again.
Thank you. I'd like to delve into your value strategy philosophy. Do you think it's possible to incorporate growth considerations into a value strategy? For example, if future market growth is factored into the calculation of a stock's fair value, and that fair value increases, it seems more growth stocks could become investment targets. Within value strategies, there are various philosophies and stances, but how does your firm integrate growth into your approach?
Yeah, that's actually a great question, because I think that many value investors, they see growth as a bad word.
Yes.
And, certainly from our perspective, and it's something that we say very frequently to clients and prospects, is that the opposite of value is not growth. The opposite of value is expensive. Our own investment philosophy, when we're thinking about truly understanding and valuing companies, we're looking out to the long term. We're creating very detailed models to fully appreciate the value of a company. And of course, there's going to be a growth component to that. But what we don't want to do is overpay for that. Now, in periods of market dislocations, such as 2022, or indeed earlier in 2025, when the market sold off based on tariff woes, we will happily, opportunistically buy companies that may be perceived as growth companies if we think they're trading at good prices. I think an interesting point here also is that today, when you look at the 1000 value index, which is the Russell 1000 value index, which is the main value index here in the US, many companies that people perceive as growth stocks actually sit in that index today. And I'm speaking to Alphabet, Amazon, Salesforce, so on and so forth. These companies that are growth names, but they, at least for a period, are trading at value prices and good value investments.
That's very good to hear. Thank you. I think one significant advantage of a value strategy is lower downside risk. So we'd like to discuss about downside risk. Given that investments are made in already undervalued assets, essentially starting from a low base. And so conversely, growth strategies invest in stocks that have often already seen significant appreciation or are highly volatile due to economic cycles and demand, leading to potentially massive declines during market downturns. Could you share your thoughts on this point?
Yeah, I think that's generally correct. If you're owning a low expectation company, i.e. a lowly priced company, and bad things happen to the overall market, there's a potential and most likely a likelihood that that type of name will hold up better than a name that has very, very high expectations and is already very, very expensive. I think if we look back over the last few years, and this clearly has been very much a growth market, but in 2022, when we had a major sell-off here in the S&P 500, we saw that the S&P was down 18%, that the 1000 growth index was down 30%, the 1000 value index was down only 8%. So it held up very, very well in that period of market dislocation. And in fact, more recently, if we just look at the first quarter of this year, the S&P was down 4%, the 1000 growth down 10%, but the value index was actually positive. And so I'm not going to say that value is always going to outperform in a downturn, because that's not going to be the case. But lower expectation companies generally, we would believe, should offer good downside protection.
So considering these points, it seems that growth and value strategies have very different risk-return characteristics, and disparity in returns is to be expected. So comparing them directly, especially with growth-leaning indices, might even be inappropriate, I believe, as it would always favor growth strategies. So what are your thoughts on comparing value strategy funds to an index or growth stocks fund? And how should we communicate these differences and characteristics to investors? Because, as I mentioned earlier, I'm always struggling to explain this.
Yes.
So I'd like to hear your thoughts.
Yeah, I think that first and foremost, investors need to be diversified. And investing in something like the S&P 500 today, they may believe that they're being diversified in their investments, but they are not. So the top five holdings in the index make up around 30% of the index. That's something to be very, very well aware of. As I mentioned, the index is trading at well in excess of 20 times earnings. We see it today as a non-diversified portfolio. And I don't think that investors generally are well aware of that. Now, at Harris Oakmark, we've been around now for close to 50 years. We've always carried out a value investing philosophy. It hasn't changed. Markets have changed. Growth has been in favor. Value's been in favor. We've always executed on what we do. And that certainly has generated very strong returns over time. But there can be periods, such as today, when value's out of favor and certain strategies may well be out of favor. I think that's why it is important to look at both the core benchmark and then the value and the growth indices to see how performance is differentiated and trying to understand why that could be the case, but ultimately realizing that there is a need for true diversification. And what could be helpful would be a core position in the S&P 500 and then another position in a value index or a value strategy such as ourselves. And I think that then over time that can smooth volatility and we would believe ultimately generate superior returns. Something that I would also note is that our flagship large value strategy incepted in 1991. So we've been around a very, very long time investing in the US with this philosophy. If you had invested $10,000 in the S&P 500 in 1991, it would be worth $320,000 today. If you invested that same amount in our value portfolio in 1991, it would be worth almost $600,000. So almost double that of the S&P 500. So we do believe that disciplined value investing will work over the long term, and we've proven that. And I think that for investors to not look to be diversified certainly could be a challenge.
Thank you so much. I feel it's very important for investors to understand the importance of value strategy now, especially now. Thank you for a very insightful and informative story.
Great. Thank you very much.
Thank you. And I'm keen to hear your outlook on Japanese equities. I've interviewed numerous domestic Japanese equity active fund managers, many of whom have expressed bullish views on Japanese equities, focusing on structural changes within Japanese companies. Indeed, Japanese equities have shown strong performance this year, aligning with these predictions. However, there's often a perception that domestic fund managers might have a bullish bias towards their home market. So I'd like to hear your perspective. I understand that your firm began investing in Japanese equities in the 1990s. That's a considerably long history. Is there any particular historical background to your firm's relationship with Japan? Or have you researched globally and including Japan?
Yes, we actually started investing in Japan in 1992. That was when we launched our World ex-US portfolio here for US investors. And clearly Japan is a very big part of that. So that's where we started to analyze Japan, and we started to include that in our investment research. For the longest time, it's been important to us to look at companies from a global perspective. And so if you think about for our own portfolios, we can invest in Japan, we can invest in Europe, we could invest in the emerging markets, so on and so forth. So Japan becomes a component of that. What that also means is that when we consider Japanese investing, we're looking at it from a slightly different lens to people who are focused purely and solely on Japan. Now, about 15 years ago or so, we had a very large US investor that came to us, and they asked if we would consider creating a Japan-only portfolio for them. They saw what we did from a global perspective. They liked what we did from a global perspective. They liked the insight that we brought to investing in Japanese companies as a result of that. And so we were in discussions with them. We actually found at the same time that there was a lot of opportunity in Japan. And so as a result, we actually created our Japan-only portfolio based on investor demand and also our desire and our view that it was a good opportunity to invest. And this was around 15, 16 years ago, which I think ended up being actually, yes, quite a good time to invest in the Japanese market.
Next, let's reflect on this year's investment environment for Japanese equities. The Japanese stock market has been exceptionally strong this year, 2025, gaining further momentum after the inauguration of the new Takaichi administration in October. From your U.S. perspective, what impact do you anticipate this new administration will have on the investment environment? Did you feel it would further boost the growth of Japanese companies or reported not so much in the US?
Yeah, so I would say that if you think about how we invest, we're looking at individual securities to own. We manage a fairly focused portfolio where we know the companies in great detail, we analyze them in great detail, and we look to own them for a very long time. So from that perspective, macro or political events, we will look at them, we'll listen to them, but they're generally not going to be a big driver of what we do. Now, that said, I would say that, frankly, the appointment of the new administration, it didn't get a lot of news coverage, except for the fact, of course, the first female prime minister, which is very exciting. But, of course, we study the market closely. And, when we consider the new administration, we're happy that the administration continues to be pro-business. We do think that, if we look back to Abenomics, and that really did start to change things in Japan, and we see that there's the continuation of that. Clearly, the fiscal stimulus announced, short term is a good thing, more spending. So short term, this should be a good thing, should feed through to positives for the market. Now, longer term, we have the fiscal concerns that the debt to GDP ratio just keeps on getting higher and higher and higher. But that does not seem to be a concern right now. So we think that that's quite good for the market. And I think also one other factor is that we've seen weakness in the Japanese yen. And as we well know, generally, the Japanese market is driven by exporters. And so as the yen weakens, the market has done quite well. So I think, there have been some tailwinds for the market in the short to medium term. From our own perspective, as I mentioned, they haven't driven what we do. But we can see that at the very least for now, the new administration's policies appear to be generally at least neutral.
Next, even before the new administration took office in October, Japanese equities were already showing strong momentum, outperforming US stocks this year. It's often said that long-standing, persistent efforts to encourage companies to be more conscious of cost of capital and share price have finally borne fruit. Having researched Japanese companies for many years, do you perceive any changes in the mindset or attitudes of Japanese companies as a whole? If so, what specific aspects indicate this shift in their mindset and attitude? Do you observe any changes?
Yeah, so, again, thinking about the fact we've been investing in Japanese companies for a very, very, very long time. So from that perspective, we think there has been a tremendous change in mindset of Japanese management over the last 10 to 15 years. Now, I think we acknowledge the fact that change can be incremental and can be quite slow when it comes to wherever you may be in the world, changing the mindset of leaders and changing the mindset of managers. But we are seeing a greater focus on capital allocation, returns on invested capital. We are seeing a greater focus on return on equity and improving that. and in that way trying to improve shareholder performance. I would say that historically, as minority shareholders in Japan, we never felt that we were first and foremost on the list of people that management were to focus on. But we feel that that's changed somewhat, and we've moved up that list now. And so what does that mean? It means that Japanese companies now are generating higher returns on equity. May not be as high as they are in other parts of the world, but certainly higher returns on equity than we've seen in the past. I would also say that management will engage with us more. We speak with management on a very, very regular basis across all of our companies, and they will engage with us and they will discuss capital allocation plans. We will propose ideas that we think could improve returns for shareholders, and they'll listen to us, whereas maybe they didn't in the past. And I think another very important thing is that independent board members that really did not exist if we look back 15 years ago, independent board members, the number of them on most companies is growing. And we think that's a very positive sign to show that there is, that there's that improving focus on minorities and not just the status quo within companies.
Thank you. Conversely, I'd like to hear what challenges do you still identify that Japanese companies face in further enhancing their global competitiveness? What are those points?
Yeah. So I think that, generally Japanese companies can be very slow to change. And I think in a very fast-moving environment, particularly in a global environment, it can be very difficult for Japanese companies to remain competitive. So I think that that's one challenge. And most certainly, I think that's also exacerbated by the fact that China continues to challenge and continues to become a persistent threat, not just to Japanese companies, but companies globally. So I think that's point number two. I think another factor is that, I mentioned earlier that many Japanese companies are export-oriented, and so they kind of rely on the weaker currency. They don't necessarily have to be as efficient, but they hope that the currency will be weak for them to continue to generate returns and profitability. So maybe they focus less on efficiency and more on hope for currency moves. And then I think the fourth thing is really that just as we look globally, and we had mentioned high returns on equity earlier, that Japanese companies continue to have quite low returns on equity versus the rest of the world, low margins versus their competitors in the rest of the world. And so, similarly, when you look at, when you look globally across an industry, which we're able to do given our investment setup, we can see that they remain disadvantaged versus their peers in other parts of the world.
Thank you. I feel they're a bit slow to grab.
Yeah, I mean, yes, but things are improving, things are changing, which we most certainly see as a positive, but we always encourage companies to do more.
Thank you. And the next question is that from a global perspective, Japanese stocks as a whole can be considered undervalued. So I understand that your value strategy aims to discover undervalued stocks globally without regional distinction, and that Japanese stocks falling into this category then form the universe for your Japanese fund. While this might lead to many Japanese stocks being identified as undervalued and entering your universe, but this is my thought. Do you then invest only in those that are even more undervalued? If so, it seems there's a risk of falling into a value trap with perpetually undervalued stocks. It's not limited to Japanese equities, but whole value stocks. How do you address this potential issue?
So I think that the argument for value investing in Japan for the longest time is that Japan was a very, very cheap market. When you look globally, Japan looked very cheap, particularly on a price-to-book basis. But then it's cheap for a reason, because it's low-returning companies with little catalyst to change. Now, what we do here at Harris Oakmark, and it's our basic philosophy, is that yes, we're looking for companies that are trading at a discount to their intrinsic value. But we're also looking for companies that can increase their shareholder value over time, and also looking for companies where management is aligned with us as minority shareholders. And we believe, considering those two further factors, not just price, but also growing shareholder value and strong management, we believe that we can avoid value traps. And so when we look, whether it's at Japan, the US, Europe, wherever it may be, we're very focused on how companies are allocating capital, how they're growing shareholder value. We want to be able to have good discourse with management. And in that way, we feel that we can avoid value traps. Otherwise, certainly you can buy a company in Japan that trades on its surface very, very cheaply. Maybe not now, but 10 years ago, let's say, companies were trading with a market capitalization less than the cash on their balance sheet. That may no longer be the case, but there was also a reason for that because nothing was ever going to change. So we try to avoid investing in those companies as much as they may look statistically cheap, but focus on companies where we have these other factors that can drive value creation over time.
Okay, thank you. Finally, I'd like to delve into the intrinsic value, as you mentioned. Finally, in the Japanese market, what unique characteristics do you believe define intrinsic value compared to the US or European markets from your firm's perspective?
So I think that, intrinsic value specific to Japan, we mentioned earlier that the Japanese companies are relatively slow to change.
Yes.
But the focus on quality of the product is something that we don't see in many parts of the world. And we do think that there has to be a premium that's paid for that. So that's one thing that we think is important. And I think, related to that is also the craftsmanship. So high quality, but, very high precision equipment. Some companies that we invest in where they're high precision equipment companies, where they have no global peers because no other companies can execute as well as Japanese companies do. So we think that that is a key factor also, to world leading companies that are based in Japan. And another thing that we think is both a positive and a negative is that the investment in research and development in Japan remains very high. And so that there is that focus on continual improvement, looking out to the long term, as opposed to just looking to maximize profitability in the very short term. Now, I say it's a positive and a negative because the positive is that it's continual improvement, better quality products going forward. The negative could be that it crimps current profitability. But we think that those three things, which are kind of interrelated, really speak to what makes Japan particularly unique from our perspective.
So craftsmanship and the quality of products is the strength in Japan. So I'm very happy to hear that. From your personal perspective, what do you think make it possible to make a craftsmanship and quality of products? What make it possible?
So I actually think it is the focus on the long term.
Long term.
Because it means that investment is encouraged, whereas maybe in other parts of the world, other companies in other parts of the world, that may not be the case. And also I think that it's also just the legacy and the history of Japan that also leads to that as being a somewhat unique characteristic. If you look at the, some maybe smaller companies in, let's say, Germany, there may be that similar focus, but at the very largest level and highest level, when we look at some of these leading companies and the need for precision, it's very unique to Japan.
Okay, thank you. I'm very glad to hear your perspective focusing on Japan. So thank you so much again.
That's great.
Thank you.
Thank you very much.
Thank you.